Good morning and welcome to the Morning Bell. I'm Robert, joined by Lizzie and Steve. It's Monday, June 15th, and markets are responding dramatically to this weekend's US Iran peace deal. Lizzie, what are the main themes you're seeing in today's news?
Thanks, Robert. The dominant story is absolutely this US-Iran deal that's reopening the Strait of Hormuz. We saw an immediate market response with stocks surging across all major indices and oil prices dropping significantly. The Dow, S&P 500 and Nasdaq all opened higher this morning, which tells us that markets are interpreting this as a major reduction in geopolitical risk. What's particularly interesting is how this is playing out across different asset classes. Oil sliding to a two-month low is creating a ripple effect through energy stocks, but it's also easing inflation concerns, which is supporting broader market sentiment. We're also seeing notable corporate activity with Fox acquiring Roku for $22 billion and Salesforce buying AI customer service platform Fin for $3.6 billion to boost their AI capabilities. These big M&A moves suggest corporate confidence remains strong despite recent market volatility.
That's a significant shift in the geopolitical landscape. How are you reading the market's interpretation of this deal?
Markets seem to be pricing in sustained stability, which is the key question here. The initial reaction has been overwhelmingly positive, but traders need to watch whether this deal actually holds. What I'm seeing is a clear risk-on rotation happening right now. Money is moving out of safe havens and into growth assets. The fact that manufacturing output stalled for the first time this year, according to today's data, would normally be a bearish signal, but it's being overshadowed by the geopolitical relief rally. For traders, the opportunity is in energy-sensitive sectors that benefit from lower oil prices. Think airlines, transportation, and consumer discretionary. On the technical side, for the major indices, the S&P 500 is testing resistance at the 5,400 level, and if we break through with conviction, we could see a run toward 5,500. The Nasdaq is showing even stronger momentum, up over 1% at the open, with tech stocks benefiting from both the geopolitical relief and continued AI enthusiasm following that Salesforce acquisition. The Dow is more measured, up about 0.5%, which makes sense given its heavier weighting toward industrials and financials that aren't getting the same boost.
What about the technical picture? Where do you see support and resistance levels?
For the S&P 500, we've got solid support now at 5,300, which was previous resistance that we've now converted. The key resistance is that 5,400 level I mentioned, and above that, 5,500 becomes the next major target. The Nasdaq is in a stronger position technically. We're looking at support around 17,800 and resistance at 18,200. If we clear that, there's not much overhead resistance until we get to the all-time highs. The Dow is the laggard here, which is typical when we have this kind of tech-driven rally. Support for the Dow sits at 39,000 and we're testing resistance right now at 39,500. What I'm watching closely is whether this rally has legs or if it's just a relief bounce. The volume profile will tell us a lot over the next few sessions.
And what does this environment mean for individual investors and active traders?
For investors, this is a moment to reassess risk exposure. If the Iran deal holds, we're looking at a potentially sustained period of lower oil prices, which changes the inflation narrative and could give the Fed more flexibility. That's supportive for longer duration assets and growth stocks. For active traders, the volatility around geopolitical news creates opportunities, but you need to be nimble. I'd be watching oil-sensitive sectors closely, both the beneficiaries of lower prices and the energy companies that will face margin pressure. The SpaceX IPO continues to generate momentum, up 6% in its second day of trading, and that's keeping the enthusiasm high for growth and innovation stories. One thing I'd caution on is getting too caught up in the relief rally without considering the underlying fundamentals. We still have economic data that's showing some softness, and corporate earnings will ultimately drive sustained moves.
That selectivity is going to be critical in this environment. Steve, let's shift to the economic calendar. What's the data picture looking like this week?
Thanks, Robert. We're coming off a Friday that showed us some concerning signs with manufacturing output stalling for the first time this year, which is a notable shift after several months of steady growth. That data point is significant because manufacturing has been one of the more resilient sectors, and seeing it flatten raises questions about momentum heading into the second half of the year. Looking at this week's calendar, Tuesday is the critical day with the Bank of Japan rate decision, and this matters more than usual for US markets because yen shorts are sitting at a 9-year high. If the BOJ surprises with any policy shift, we could see significant currency volatility that spills over into dollar-denominated assets. Wednesday brings us retail sales data, which is going to be particularly important given the consumer concerns we've been seeing in recent surveys. Economists are expecting a modest increase of around 0.4% month over month, but any miss could reignite recession fears. We also get industrial production figures Wednesday, which will give us more color on that manufacturing weakness we saw Friday. Thursday has housing starts and building permits, and these have been trending lower as mortgage rates remain elevated. So we're looking for any signs of stabilization. Friday rounds out the week with the University of Michigan Consumer Sentiment final reading, and the preliminary number showed some deterioration, so we'll see if that holds. The other thing I'm watching closely is how the drop in oil prices feeds through to inflation expectations, because if consumers see gas prices falling, that typically boosts sentiment and spending power pretty quickly.
Those are some important data points that could shift the narrative. Lizzie, let's talk about crypto. What are you seeing in the digital asset space?
Crypto is having a strong reaction to the same geopolitical developments we're seeing in traditional markets. Bitcoin pushed above $66,000 this morning, which is a 2-week high, and we're seeing what looks like a short squeeze building. The key development over the weekend was MicroStrategy, Michael Saylor's company, adding another 1,587 Bitcoin for $100 million, bringing their total holdings to 846,800 Bitcoin. That kind of institutional accumulation is a bullish signal. Coinbase CEO Brian Armstrong came out saying he thinks Bitcoin may have bottomed at $60,000, which adds to the growing narrative that we're entering what some analysts are calling crypto spring. After a prolonged winter, the technical picture for Bitcoin shows we've reclaimed the $65,000 level, which was significant resistance. And if we can hold above it, the next target is $69,000 to $70,000. What's interesting is the mining difficulty just dropped 10% in the 11th largest downward adjustment in Bitcoin's history, which reduces selling pressure from miners. For Ethereum, we're seeing mixed signals. ETH futures are flashing some bearish indicators, but there's strong institutional buying with BitMine adding another $136 million worth of Ether after raising $274 million in preferred stock. Ethereum is also making headlines for being able to quantum-proof accounts for just 7 cents, which showcases the network's efficiency. The challenge for ETH is it's stuck in what looks like a bearish flag pattern technically, so we need to see a breakout above that pattern before getting more aggressive. Solana is quieter in terms of specific catalysts, but it's likely to follow the broader crypto market trend. The overall sentiment in crypto is shifting bullish, with multiple analysts declaring that crypto winter is over.
What about the institutional versus retail dynamic in Bitcoin right now?
That's a key question because we're seeing a clear divergence. Institutional players like MicroStrategy, BitMine, and corporate treasuries are accumulating aggressively. MicroStrategy just announced they're continuing their $100 million purchase strategy. And this is happening even as they acknowledge Bitcoin sales are necessary for their digital credit business model. That tells you they're confident in the long-term trajectory. On the retail side, sentiment is improving, but we're not seeing the same kind of FOMO that characterized previous bull runs. Retail investors seem more cautious, which is actually healthy for a sustained move higher. The risk is that if we get too much institutional concentration, any forced selling from leverage positions could create sharp downdrafts. There's also chatter about Bitcoin potentially crashing to $48,000 if certain historical patterns trigger, which keeps some traders on the sidelines. But the order book structure right now shows trader confidence is building. And the fact that we're seeing short squeezes suggests positioning was too bearish heading into this geopolitical relief. One thing to watch closely is Tuesday's Bank of Japan decision, because with yen shorts at 9-year highs, any surprise there could create currency volatility that impacts Bitcoin and crypto broadly. The correlation between traditional markets and crypto remains high, so the Iran deal holding together is important for sustained gains.
Well, that gives us plenty to watch as we move through the week. The intersection of geopolitical developments, economic data, and market positioning is creating a dynamic environment across all asset classes. Remember, do your own research and consult with financial advisors before making investment decisions. The information we discuss here is for educational purposes and shouldn't be considered personalized investment advice. If you found today's discussion valuable, please subscribe to the Morning Bell and join us tomorrow as we continue tracking these developing stories. I'm Robert, thanks for listening.